Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host here in Amin. Today, we're tackling one of my favorite subjects, technical analysis, and specifically how it might help investors potentially profit on their next trade. I like to think about securities trading a bit like a game of chess. Now, if you've ever played before, you know that anticipating your opponent's next move is key to winning. And that's what technical analysis aims to do for traders. It's an approach to studying securities price action and then gleaning trends and patterns from it. And importantly, how other traders in the market react to them. The hope is to better understand market sentiment and psychology to get a jump on the security's next move. Now, there are many different ways to apply technical analysis, just like there are many potential strategies in the game of chess. So, we're going to spend the next hour picking the brain of a grandmaster of technical analysis. He's a resident expert when it comes to technical analysis here with us at TD as well, and to get his take on how it's done. Joining us is none other than Patrick Ceresna, founder of Big Picture Trading, and he's the voice of a couple of podcasts, Macro Voices and the Market Huddle. So, Patrick, thanks so much for being here. How are you doing?
I'm doing great here, and thank you for having me. It's always a pleasure to be online here with TD.
Excellent, excellent. I know we've hosted you for a number of our technical analysis series, so glad to have you back with us again. I wanted to get to know you a little bit better for most of our audience who may not be familiar with the work that you do. So, can you tell us a little bit about your professional experience with technical analysis and the work that you do at Big Picture Trading?
Well, I started in the industry, in the financial business, no different than you, at a competitor bank I won't mention. But basically, I came into it as a portfolio kind of investing fundamental framework, right? Which is we build portfolios, we manage people's money, diversification, and having right assets is just the way that you bring together and compose a portfolio. And as I was in trading and investing, I realized that there was a missing gap in the fundamental approach, because when you analyze balance sheets and cash flows and dividends and all of these elements, like multiples that your stocks are trading at, it gives you insights to how valuable a stock is, but it doesn't tell you what the prevailing trends are and what's working and where the money's being made, and when is the time to potentially exit a position. And so it gave you a framework of how to build a portfolio, but there was an opportunity to find strategies on how you can be a better executor of your trades and managing the different cycles. And this is where I fell in love with macro analysis. This is where I get involved with Macro Voices, where we have our guests from all over the world, some of the top macro thinkers, and then we have Market Huddle. The goal is to create and bring guests on that are super smart about the big picture. And in the big picture, somebody can tell you, oh, the US dollar is going up or down, or interest rates are going to trend this way, and Fed policy is going to be that way and that way. The macro gives you a framework of what is happening and why it's going to happen. But it doesn't tell you when it's going to start and where it's going to go. And so what happens is you can have someone say, oh, gold's going to 5,000. Definitely this decade, it's going to 5,000. And someone will make that kind of a call. And 2 years later, gold is still at the same price it was earlier. And there's no move to 2,000 or 5,000. But bottom line is answering when is it actually happening is actually a very important bridge. And, you don't want to misallocate capital to something that isn't actually yet manifesting itself in the pattern. And this is where I felt that there was a huge opportunity to combine fundamentals. I always like the saying of, I like to technically trade fundamentally good things. I like to basically first have a real fundamental reason for something, and then the technicals are the way you tell a story, manage risk, take profits. It's a way that you structure the story beyond the fundamentals. And so that's really, where I spun off and started a company. For years prior to starting Big Picture, I was a part of a day trading firms where it was nonstop of buy sell, and I really saw that the opportunity was not to micromanage trades and try to scalp and fight the algos and high frequency trading, but rather to just stay on the right side of very big major trends. And if you're on the right side of that, is where you have the opportunity to actually make real money. And so that's the idea of big picture trading, is that we trade but we're focused on the bigger trends and not the short term squiggles.
All right, excellent. I loved how you summed it up there with the fundamental and technical approach. So really, fundamentals tell you what to invest, and technicals are telling you when to invest and structuring those ideas. So fantastic. Now, we did want to pick on the technical aspect a little bit more with you. So before we dive
Mm.
into a full Q&A session, we're going to get you and to know you a little bit more and your approach to technical analysis. So first question I'm going to ask you related to that is, how would you describe technical analysis and the ways that it may be useful to a trader? You alluded to some of them already, but if I can get you to go into that a little bit more.
Absolutely. There's a psychology to investing and trading, and as an example, if you don't have a trade plan, you don't have a method of determining where you're wrong or where you're right very easily, and just buy something on fundamentals, a couple of psychological things kick in. For instance, a common human nature element is most investors are unwilling to sell something at a loss, and so the moment
Mhm.
the position goes against them, the natural reaction function is to say, I'm going to wait till it comes back to break even, and then I don't have to admit I was wrong, and what ends up
Yep.
happening is that then when it goes down against you 10% or 15%, you become trapped. It's an old saying we had on when I was back on Bay Street at the bank. Thing is, like, what's the definition of a long-term investment? It's a short-term trade you're losing on, and and so what happens is that often we actually do a lot of damage to ourselves by getting stuck in things we wouldn't have been in if we weren't losing on them. And what ends up happening is we end up getting this hodgepodge of a portfolio of things, and we don't really want to be in all of these, but we don't really know how to change it or when to get out or should I cut my loss. See, technical analysis creates structure. It creates rules. It even when you let's say have a rule that says I buy when only when the moving averages are bullishly crossed over, and I refuse to own something when the pattern fails, then you have a set rule for I have a criteria for when I'm getting in, and I also have a criteria for admitting when I'm wrong and I shouldn't be in the trade. And technical analysis to me creates think of like bowling. It gives you the bumpers on the side that allows the bowling ball to stay in the lane. It's the same way of like it forces you, while you're not going to hit a strike every time, it forces you to follow certain sets of rules to keep you going down the path. And when you follow some basic rules of technical analysis, it helps create structure for you. And that's what a lot of people that are long-term investors sometimes lack, is the ability to know, when am I going to take my profits? Where am I going to cut my
Mhm.
loss? Where do I rebalance into another opportunity? Those things can be answered when you start to analyze the markets. The thing that technical analysis does and why it's so important is it's the study of price action. In other words, a stock can't go up unless there are more buyers than sellers. It's such a basic concept, but
Yeah.
generally, you can have some hotshot walk onto, BNN Bloomberg and say, "I'm buying this stock. It's got this story and this story," and then you go and look at it, and for the last week, it's been nothing but someone hitting the bid, and it's being distributed. Well, why the hell are you going to buy this? It's like, this guy is clearly touting a stock that it's not being accumulated. Well, if it was such a great opportunity, it would show technical characteristics of accumulation, like there are that there's buying coming in there. The charts don't lie. And the thing is that you can hear all of these stories, but the chart tells the truth. And so it's a way of actually kind of confirming and biases in the markets.
All right, that's a great take on it there, and we're gonna get down into the nitty gritty of it. So just folks, just so you're aware, we are going to be not just chatting about technical analysis, but we're gonna be showing it on charts as well, and kind of how through the lens of Patrick and how he analyzes those different securities and different variables as it relates to the market. So we'll get into that in a moment. Just to mention, we have a poll up on screen just to get a gauge or a sense of everyone who's watching here today, where their level of knowledge is when it comes to technical analysis. So please do, everyone should see it. We've seen the majority of you taking a stab at that poll. So do answer that poll. And then we'll queue up the results in just a second over here. Back to a question. I'm going to go with you, Patrick, on that. We know that technical analysis is, there's so many different tools that you can use to do your analysis with technicals. So, what sort of indicators are you looking for that help you spot potential trading opportunities?
So, uh, what I would step back a little bit and just kind of reflect on one thing. The markets on the charts, everything is derived from three factors: price, time, and volume. It's like what price is it traded at, how much time has passed, and how much volume is traded. And to all the thousands of different ways to approach technical analysis, to some degree or another, they all derive the outcome from those three inputs. At least as far as I'm aware. And so there's a huge redundancy in technical analysis where most indicators will often be giving you buy signals in similar windows of time, because when the price and time or volume are moving a certain direction, the different, even though the indicators and their math inside them are all interpreting it in a different manner, they're all reflecting the fact that the price is rising, and therefore they're all going to give you an indication that there's some sort of buying going on and you should pay attention. And so, you could ask me a question of, which one's my favorite or something like this, but I actually never like to get overly pigeonholed into that. I mean, I can certainly say that the ones that we covered in the programs that are on your TD website are ones that I actually felt were important enough to include in these programs. I think for the average attendee that's listening to this session, it should always start with moving averages. Like, I think the moving averages is it's the simplest and cleanest way for somebody that in the beginning stages. And as you become a little more sophisticated, or you're looking for some further confirmations, you can add overlays, you can add oscillators, you can do all sorts of different things. But even someone like Paul Tudor Jones, one of the greatest investors and traders of all time, has this very simple concept that says, I don't buy stocks unless they're above their 200-day moving averages. Like
Yeah.
that's it. Yeah, I mean, here's one of the greatest investors, and he comes online and he says something as rudimentarily basic as that. And
Yeah.
and so I think that generally, if I was to say where a lot of the listeners should start in that, is just to know where it is. Like, a stock cannot be in an uptrend and not be trading above its 50-day moving average. right?
Mhm.
This is impossible.
Yeah.
It's like the average of its 50 days. If it's not above the average of its last 50 days, it's not in an uptrend. You're misinterpreting it, right? And so there's some very basic things that keep you on the right side of the market using moving averages. And I think that's if I was to say like the one thing that outside of Fibonacci analysis and other things that most of my people that know me that I utilize, moving averages I think are the cleanest and simplest thing
Mhm.
that almost everyone can apply very early.
Yeah, I was. It's interesting you mentioned that because I was listening to one of the Market Huddle episodes, and I think with you and is it
Kevin.
Kevin? Yeah, Kevin.
Yeah.
And he was always harping on you about you have a rule of the 50-day and not trading unless it's above the 50-day as your hard rule,
Yeah.
and not necessarily shorting if it's below, though, looking for price trends, but one to keep in mind there for us.
It's a simple thing. Like now, obviously, I don't keep my trading that simple. I have
Yep.
a far more comprehensive way of finding my asymmetry. But
Okay.
generally, if, for instance, if I'm aggressively entering a trade in an early stage, my confirmation that the trade is working is that it, let's say, bullishly gets above its 50-day and stays there. I mean, if not, then it's proving that I made a wrong trade call, and I have to find my way out of this trade, or I'm going to lose money, right? Or more money. Depends on where you're in that position.
Absolutely. All right, so we're going to get to the next question in a second. We did have the poll results, and Patrick, I'll get you to glean in on this, but we asked everyone kind of where their knowledge of technical analysis on these four different sort of scales. And the majority of us have confirmed that we're kind of that moderate level. We've dabbled with it a bit, but we've got a whole lot to learn. And you're in the perfect spot to do this. Is this
Yeah.
any surprise to you from what you see in general when you have your listeners tune into your shows?
Yeah, I mean, everyone starts off as an investor, and so they always are first buying a story. I heard about this new software company that's doing this. This mining company is going to have this new discovery, and it's going to, blow everyone's mind, or the size of the mine or something. There's always a story, and investors love stories, and so most of us, our first exposure to the market is the story, and that's okay. I'm not even trying to say that in a negative way, but as investors naturally progress to, I'm going to do this full time. I'm not going to work a job, but I'm going to be an investor. Well, when you're sitting at home, the natural thing is, well, I'm going to watch what the stock is doing, and that's when usually the chart comes up, and people start to observe the way the price is behaving, and then they
Mhm.
introduce themselves to some of these principles on technical analysis, and that's when the Pandora's box opens, and they're like, "Oh, I want more."
Yeah.
But it's a natural progression, and every investor is at a different stage of that progressive learning curve on there.
Yep. All right. Excellent. Now, one thing we get when it comes to doing technical analysis, of course, you're studying price action, and you have a whole host of different chart styles that you're using.
Hmm.
So, amongst those, what do you prefer with the chart styles when you're looking at the charts there?
Yeah, it's funny. I well, first, I've just because of my day trading days back in the time, in my brain, the candlestick formations are just embedded in my brain. It's like the only way I naturally visualize price action now. So and it's just I'm a creature of habit that way. And so to me, I've always used candles, and it just makes sense to me when I look at a chart. On there, there is of course the more advanced ways of looking at charts. Some people like to use Renko charts, Heikin-Ashi charts, and others people point figure charts, or other people say, no, I'm going to keep it simple and only have a line chart, and I'm just going
Yep.
to look at the closing prices and not confuse the information. But I like the story that's told with candles, because you in a line chart you can't see. In a line chart, you can't see that there was an intraday price reversal. And so
Mhm.
a lot of times what will happen is a stock will have this huge gap higher, and
Yep.
sell off for the rest of the day, and end on a low. That on a line chart, you will see that it just closed down there at the low, and you didn't see this huge intraday reversal. But that's huge information. It's big from a price action perspective. When bullish news comes out, and the stock's first reaction is a very bullish one, but the really smart money and big money uses that
Mhm.
excitement to unload as much stock and put and reverse the stock as they're unloading huge inventory into the good news. Well, that tells you something. Tells you the stock is clearly fully priced because when you're selling into good news, it means the news ain't getting any better. It's
Yeah.
and so you're trying to sell at a thing, and so you can't see that on a line chart, but the candle will give you that big shadow at the top or other types of parts of the formation that will give you the clues that something like that's underway. So I'm a candle guy.
All right, excellent. I am as well, and we've done the actual an episode with you on candlesticks. So, folks, if
Yeah.
you do want to learn more about candlesticks in detail, please do check out that webinar we've done in the past. We'll link it there for you. Also, we do have a trivia question up. This is it's an interesting one. So, the trivia question that we have up on screen, you guys can take a stab at answering it. But when was the first recorded use of technical analysis? And the options you have here are 19th century London, 17th century Amsterdam, 18th century Japan, 20th century America. I have my thoughts on it. We'll get to that in a moment once we get everyone to clue in, and we'll get Patrick to weigh in and see if he's guessed right here. But we'll continue on. The next question I have for you, Patrick, is one that comes up a lot. This comes up a lot in our round of teaching technical analysis, and this is the question about: is it mainly for short-term traders, like day traders or swing traders, or can it be used for long to medium-term traders as well, effectively?
Well, of course, it can be used on every time frame for every type of trading. And this is, I think, is the biggest misconception that needs to be unwound. A lot of people assume that when I do technical analysis, that means I'm being an active trader, short term, and that makes me a day trader or something like this. And I don't want to be a day trader, so that means I can't use technical analysis. And I think that's hogwash. Ultimately, the technical analysis can be used to the smallest degree by very active traders that are buying and selling and trying to profit from fluctuations in the market. But some of the most powerful prevailing trends are evident over cycles that last many years. If you throw on, let's say, the S&P 500 chart, if you want to share a chart,
Yeah,
and put up the S&P 500, whatever SPY or whatever you want, and on a weekly basis, and throw a 20-week moving average on there. The point here is that after the COVID crash, notice simply that once the market started bulling and got above its 20-week moving average, it encompassed the entire bull market advance. And it
yeah,
wasn't until the 2022 bear market began that it dropped below it. I mean,
yeah.
it's such a basic rudimentary thing. This is not about day trading. This was a signal that was 18 months to give a reversal signal. There's nothing day trading
Mhm.
about this. This is about a simple technique for recognizing when there are bull and bear market phases, and like so there you don't need to be a day trader to use technical analysis. Even if all you did was overlay option hedges and or reduce your overall weighting, increase cash positioning when you get a crossover. You don't need to make everything, buy everything, sell everything. That's actually, I think, the biggest misconception retail investors do is they want to
Yep.
make everything black and white, all in, all out. Everything has to be this incredibly simple black and white thing. But ultimately, if you just simply use this as a way to say, no, you know what? The market is not in a bull trend anymore. So I'm going to raise cash and just be defensive because that means there's going to be a better buying opportunity at some point in the future. Right.
Yep.
And it's just such a simple thing, and it's not day trading. This is just a perfect, simple example of that.
We did want to just go over the trivia question and see what the responses came through with over here. So if we can cue those answers here for everyone. Patrick, what was your answer on this one, by the way?
That's tough because I know that the candles were being used in Japan on the rice exchanges
Right.
back then, but also the first stock to ever trade was in Amsterdam, the Dutch East India Company, the VOC, and so but I'm not certain of whether they use technical analysis to track it. My guess is Japan.
Japan. Okay, I guess Japan as well, based on the same thing when they're trading the rice receipts. In fact, we would all be wrong. All of us collectively are wrong because the answer is Amsterdam. Your second hunch
Uh,
there, 17th century Amsterdam. So the story
mhm.
goes that there was an Amsterdam-based merchant and financial expert by the name of Joseph de la Vega, and he wrote about techniques he used to predict stock price movements on the Amsterdam Stock Exchange in his book. Get it? I love the title of this one, Confusion of Confusions, in 1688. So that's one I'm definitely
There you
going to
go.
pick up there. But
Yeah,
there you
no,
go,
you
folks.
know what? Amsterdam and the Dutch were actually huge innovators of modern financial markets.
Yeah.
I was there just last year and saw the very first stock exchange that ever existed in downtown. They created the very structure of a corporation. You know, when the Dutch East India companies, they would pool risk for sending these ships out for stuff, and so they created the joint venture corporations and other things that are basically the companies we have today. And so, not shocked. But my first guess was the Japanese, but I was wrong.
Yeah, no, so was I. But yeah, that's interesting information for sure. All right, I'm gonna throw you one more question here before we get to the audience questions here. This is one I love asking. Is you've honed your craft over many years, of course, with technical analysis. So, what are some of the biggest lessons you've learned over those years using technical analysis?
Consistency. The so I when first thing I did in the early 2000s was to take the CMT course on technical analysis. So I got my
Mhm.
designation. So it's a 3-year program. So like a hotshot kid with his first year done, I had to learn over 50 different indicators and write papers on this and do all this. It's like I know my
Yeah,
and basically the first thing I do is go gunslinging in there with all my newfound information, and basically I would start doing like a one trading technique, and I would be doing it for a couple weeks. Suddenly I was going through a little short-term losing streak, and it's like, no, well, I'm going to try this one. I'm going to try this one, and then at the end of the year, I looked back and I never did one thing consistently. I
Mhm.
every time something was just doing a little bit different or something that wasn't working on the short term, I
Yeah,
immediately went and modified and changed it and looked into someone else that was doing something differently. And how do you even evaluate? Um, Whether you're on the right track if you can't get a large enough sample size as to whether or not you're actually doing something worthwhile. The reality is um, losing streaks and drawdowns are a part of the trading sequence.
right.
As an example, I'm trying to remember the statistic. Oh yeah, if you have something like a 60% winning percentage,
Yeah,
what is the probability that over 100 trades in a row, or actually no, even better, a flipping of a coin, take a 50-50 chance that you're going to be right or wrong, over 100 flips of the coin, what are the chances that you're going to have 8 heads or tails in a row?
what are the chances?
It's some ridiculous number like 80%. Like you know
Wow.
what
Okay.
I the point is that even though it's a 50-50 on every flip, and this is why
Yeah.
like gamblers when they're betting on black or red on a roulette table or something, they're always, oh, there's 6 blacks in a row, I got to bet red now. Like what happens is everyone is shocked how many sequences of one of a 50-50 odds can happen in a row. And what ends up happening is that if you're doing a large trading sample, it is guaranteed there will be a point where you're going to place a trade and it's going to be a loser. Place another trade it didn't work. You place another trade,
Yep.
got out at break even. What happens is that investors in their brains do not believe this should happen. If I'm good at what I do, I should not experience multiple losing trades in a row, and therefore they are one losing streak away from abandoning that way of trading and then rushing out to buy some other course, some other thing somewhere else because somebody's got to have it figured out better than what I'm doing. So consistency is actually so important. You need to have a discipline, a trade plan, a methodology that you follow, large
Hmm.
sample sizes that you can evaluate what your trading successes are and failures. All of these things happen. You just don't flip flop. Flip flopping from one thing to another is actually um, going to get you nowhere.
Yeah. No, I like that, and I think we all get. I think we're all victims of that, anyways.
Oh, we all are. We all are.
We go into these losing trade mentalities, and then we want to do some revenge trading to make up for
Yes.
those
Oh,
losses,
that's the
and then
worst.
yeah, and then you have these behavioral biases that are going to kick in all from there,
Yeah,
create the
like
snowball.
that's not even including revenge. Bias where basically you double down or you
Yeah,
try some kind of a trade to make it all back. Those are all spirals of those are all ways people that over the long term will find a way to hurt themselves.
yeah,
What the best traders can do is persistently manage risk, ride out the drawdown sequences, and be there for the really robust upside moves when they start to materialize.
absolutely, love it. All right, Patrick, we're gonna leave it there for now. So thanks so much for sharing your approach to trading and technical analysis and kind of your psychology behind it. We are gonna get to our audience questions now, who want to learn more about technical analysis from you. Now, to that end, we do have a poll up to see which question you'd like Patrick to tackle first, or we're gonna get your question first from an audience. But out of these popular questions, which one do you want him to answer the most? So we're going to get you to vote. You do have the option of picking multiple ones. So we're going to go, it's going to be a popularity contest on this one, and we'll pick some of them
Perfect.
for you. Now, first question, we're going to get it. This one's coming from Sam. I'm just going to read it to you, Patrick, since we
Mm-hmm.
do still have the poll up there. But the question is, how many technical indicators is too many? So this is one we get a lot about, over analysis paralysis. So what would you say
Yes.
is too many when you're doing and building your framework there?
So go back to what I said 15 minutes ago, which is that you have to step back and reflect that every indicator is a mathematical interpretation of price, time, and volume. And so
Yep.
there is a redundancy in all of them. So once you get past one or two indicators, you are almost just creating noise. Uh,
Mhm.
Ultimately, if a stock is in a bull trend, the moving averages, the MACD will stay open the whole way. And during
Yep.
the entire bull trend, it's not going to reverse and so on. At the same time, the RSI will stay above 50 during the entire bull trend. I
Yep.
mean, really, do you need all three? Ultimately, only one of them. Things like you want to find one or two technical analysis techniques that have a different structure. For instance, a stochastic is measuring a high-low range
Yep.
and telling you where the closing price is relative and giving you a signal. It is incredibly responsive for an entry. So you're going to get an early entry signal very quickly from a stochastic simply because the price moves away. It's immediately going to reflect it. It's going to be a very early. But something like a moving average crossover has a substantial lag, and it
Hmm.
won't give you the buy signal till a little bit later, like 3 or 4 days later,
Yep.
when the stochastic gives you. So what happens is you can have two techniques. One where you put a starting position on with the stochastic and you're waiting for the moving averages to confirm that the original buy signal was a good one. You can use something that one that kind of complements another, and you're looking for some sort of confirmation. That's just an example. You can find your own little
Hmm.
combination of which way to do that. But 100%. Analysis paralysis is the worst. And what is even worse is that once you put too many things on the chart, what you stop doing is looking at the price. And the price,
Yeah.
like I literally now, after 25 years of trading, can make the vast majority of my trading decisions by simply looking at the price alone. And
Mm.
the thing is that when you rely too much on indicators, you are putting too much importance on the indicators, and subsequently, you're not studying the price. And price action to me is critical. And so I would basically, I would say three is the max.
Yeah.
And if you can wind it down to two, it's even better.
Yeah. And I think that's kind of what our approach as well when we're talking about technical analysis and conveying it to our audience is keeping it simple to just three. And really, those additional ones are there to look for confirmation, as you mentioned. You want to see that if you see a signal occur, check through those next one or two indicators that you have and see if they're confirming that move there for you, or if you think there's a move on, you don't
Yeah,
want to jump into it too early. So that's where you get those confirmations. So
yeah.
excellent. All right, so we got the poll results up. We're gonna take the top two voted questions here, and we're gonna start with that. So let me start with this one here. The bottom one. This was an interesting one. Are there any technical indicators that you feel are overrated and not actually as useful as some traders might think? Ah, there's a big field out there. So any ones that you felt in your experience that just don't do it?
Overrated. I okay. I'm not saying that stochastics and RSI are necessarily overrated, but I believe that the way that they are taught to be used is not the best way to use them.
Okay.
So uh, typically an RSI, relative strength index,
Yeah.
usually depicts when a stock is incredibly oversold or overbought.
Hmm.
And a lot of technicians feel that when something is overbought, it clearly means that it is a shorting opportunity, or you have to get out. At the same time, when something is incredibly oversold, it means that it's cheap and it should be bought. And the problem I have with that is that they forget that their trend is your friend. There's a
Yeah.
reason, PayPal went and lost 70, 80% of its value, or Disney continues to make lower lows after a year of selling. The fact is that if it was oversold 6 months ago, it didn't mean it was a good idea to buy it. And so to me, the using an oversold or overbought indicator is a dangerous tease to forcing you to trade against the prevailing trend, which is usually not a good thing. Sometimes you're lucky and you catch
Yeah.
this top and you caught the exact turning point, but there is literally, I would say, 1 out of 5 times it will work. The 4 times you're going to find that the prevailing trend is still the prevailing trend, and you're just going
Yeah.
to get chewed up. Fighting the trend that you should have never been fighting. And so this is where what I would do is if I'm using something like an overbought RSI or oversold RSI as a buy signal, let's say, I would only then look for a legitimate signal like a moving average crossover to actually validate that a new uptrend has begun, or something else other than
Hmm.
just the oversold state of the RSI
Yeah.
alone. And so that's one over eight. The other thing to forget about a stochastic is, while I think stochastics are great for entries, to
Yeah.
enter a position, it is a horrible trend following technique.
Yeah.
Because it, let's say, is talking about the high low range of, let's say, the previous 14 periods. The thing is that as soon as the stock reaches the high end of its 14 day period, its stochastic's already bouncing its head along the top of the indicator. Yet there could be these trends where the stock is going up for 2, 3, 4 months, and the stochastic is saying, "No, we're up here.
No,
You should be
we're up. Yeah,
worried. You should be worried. Get out.
yeah,
Maybe you should reverse." And then you miss this amazing trend that lasts for months, and
yeah.
stochastic got you to psych out and get out of the trade too early. And so with stochastic, I would get in with it and then shut it off. And with
Hmm.
RSI, I would make sure that you have some other confirmation beyond overbought and oversold alone to be calling a major trend turn.
Yeah. And actually, just on that point, I wanted to maybe get you to pick your brain because there's this important concept about divergence. I mean, we talked about overbought and oversold levels, of course, but divergence, which is exactly what you mentioned,
Mm-hmm.
is you want to see overall what the trend is on that particular study. Let's say the RSI, which direction is heading, comparing it to the price action. Is that something you usually factor in as well when you're doing putting on those indicators?
Those that are newer to technical analysis and cannot see the divergence in price trend through the price charts themselves, the divergence in the indicators will equally show it. Momentum
Yep.
indicators and RSI divergences or the MACD histograms, you'll start seeing all of these kind of momentum losses that are diverging.
Yep.
That's fine. But for me, I visually can now, after 25 years of trading, I can see when the stock is losing upside momentum, and that usually is an indication that distribution is starting, the stock price is getting heavy, and you know
Hmm.
that this is a level where you should be just careful. It doesn't mean you have to do something immediately, but it just means that you probably don't have as much asymmetry in pressing the upside anymore. And there should be a strategy for how you keep the profits, and that's actually a really important thing for people to learn. Is that after you've been in the trade,
Yep.
your brain has to switch from is this a great buying opportunity? How much money I'm going to make? To now I've made all this money. How am I going to make sure I don't give it back?
Yeah.
You have to have like this switch in your brain that puts you in a different mode, and a really good trader can start to sense when the asymmetry is no longer in their favor.
Yep, absolutely. Making use of those stop losses, folks, and we'll talk about that as well when I ask you a question about managing risk. Um, just wanted to tackle the next popularly voted question here from the poll. Is the question is, my understanding is you like to use options when you trade. You're a big options trader, Patrick.
Mhm.
How do you use technical analysis to help you trade options against a stock, for example?
Uh, I don't use technical analysis to help me trade options. I use options to help me manage risk on trades I'm taking with technical analysis. There's a hierarchy. So
Okay.
my hierarchy is macro fundamentals driving market conditions that influence corporate fundamentals that technically manifest themselves on the chart, and that when you place the trade, the option gives you the ability to construct a better asymmetric payoff. And so our goal is, well, if my stop loss is $3 lower than where the stock is,
Hmm.
and yet I can go and buy a protective put for the next 2 weeks that gives me a guaranteed exit at the prevailing price, and it's only going to cost me $1.25.
Yep.
Well, now instead of risking giving back $3 of my gain for a guaranteed $1.25 cost, I've secured a guaranteed sale price at this price. And so
Okay.
suddenly you are able to redefine the parameters of the trade. And so you're always looking to see whether the options market is offering you a better payoff profile than you trading the stock alone. And so I use the options as a strategic tool that gives me more choices than simply to buy and sell the stock, which is the only choices stock traders have.
Okay. Okay. Excellent. I do like that. And we'll maybe look at an example when we get to it there. I just want to continue on with the next question that we have on screen. So we're going to bring this question up. This is a question from Bob. And let's cue this up. And Bob's asking, look, stocks can often be thought of as either trending or range bound. I tend
Mhm.
to look at Ichimoku cloud charts and MACD for trending stocks and find that in range bound stocks, Bollinger Bands and RSI make a good combination. What's your comment, or can you comment on this?
Yes. So I'll comment on a much bigger scale, which is that generally beginners recognize that they or believe that stocks are either going up or they're going down. And only more seasoned investors recognize the market structure, which is the way I would describe it is markets go from a bull cycle to a distribution phase to a bear cycle to an accumulation phase.
Accumulation. Yep.
And when a stock is in a distribution phase or an accumulation phase, it can often have a prolonged basing period where it stays trade range bound for an extended period of time where a prevailing imbalance of buyers or sellers is not manifesting to drive the price either higher or lower, but rather,
Yep.
for instance, a certain amount of value investors are defending the price at a level where they're equally matching anyone that wanted to sell, and there's quiet accumulation, trade range bound price action. Yes, if our attendee here is asking, like what are the techniques that you can utilize? Again, I have at least I appreciate the techniques he's saying, but the trade range bound markets are most easiest to identify by simply observing the price itself.
Mhm.
If you see that a stock can't leave its trade range, let's just take the price of copper. And copper has for the last 4 months not been able to break a 50-cent range. It literally is today trading in the dead center of its 4 month range. This is evident on the price action. You don't need to go and try to find all sorts of techniques that are going to confirm something that is so evident when you're simply looking at the price. The reality is that when a stock begins trending bullishly or bearishly, that is where a pattern of accumulation and distribution becomes evident through higher highs, higher lows, indicators open up. Volatility starts to return. In the case this way, Bollinger Bands may open up. All sorts
Yep.
of different things will start to happen. And so I hope that helps.
Yeah, no, I think that sums it up well, and your approach to at least looking at those trending or range bound, markets or stocks in particular. So fantastic. Next question we got here. This one's coming from Larry. Larry's asking on the time frame. So, which timelines would you utilize if you're a passive trader versus a tactical one? I tend to look at monthly, weekly, and daily charts to see what the market has done, and then ask, what is the market trying to do? So, how
Mhm.
good a job is it doing, and what is most likely to happen there? So more on the time frame scenario there for you, Patrick.
Yes. The the issue with monthly charts is by the time a monthly chart gives you a signal, it usually lacks a tactical element. There's
Mm,
such a lag and such a long time for something to happen. Like, you look at some of these extraordinary explosive moves, like what crude oil did in the last 1 month, what uranium did in the last 1 month. Like these moves are so huge, but by the time you get a monthly signal, it's kind of late to react. So I appreciate the
yep.
fact that he's breaking it down to weekly and then daily. I think you always want to respect monthly charts to just have a grasp on the underpinning structure of the way the price has been behaving over a long period of time. I feel for most investors, a weekly chart is the best fit because daily charts tend to illustrate trend moves that last several weeks or months.
Hmm.
And if you are an investor, not a trader, you're going to be in and out too many times. You're going to get on daily charts. Well, look, if you're a swing trader and you're okay with a 2 week to 2 month time frame, then daily charts are perfect for you. But if you're an investor and you just want to be making sure you're on the right side of major prevailing trends and that you're avoiding things like notice on that weekly chart of the S&P we put with just a 20-week moving average how clearly it depicted the S&P bull market over the 18 months off of the COVID low. In the same manner, if you're an investor, the weekly charts just will be the cleanest way of making sure your investments are on the right track and the right trends. Daily charts is where if you know you're looking for an exit on the stock, and or this is a new opportunity, I'm looking for that first entry, and you're trying to hone in on a strategic entry or exit on a long-term holding, breaking it down to the daily charts gives you a little more of a responsive or faster signal,
Yeah.
that gives you maybe a more tactical entry or exit. But generally, once you're in the trades, you're going to get noised out of your trades too easily if you're just focused on daily charts.
Yeah, and I like that fact because I personally use moving averages rather than looking at those time frames, more so just to assess those, just what you mentioned, because you don't want to have those too many signals going off at you and being confused by it. So I think moving averages are perfect where you set that up within that, the 20-day we looked at, for example, you might do the 50 and stick on the 200 as well, because the longer the data that's in there, the more lagging it's going to be. So
Exactly.
this is just a way to think of it there. All right, excellent. Next question. This one's coming from Gregory. The question here is: do you rely more on drawing trend, support, resistance lines, or indicators, overlays, and oscillators? So, are you more hands-on with the chart, or are you going to rely on some of the pre-made studies there for you?
I would even though I'm not like they make fun of me on the market huddle for the king of crayons, whatever the nickname they gave me. The idea of being able to just see prevailing price trends is the first and foremost thing. Where previous highs, lows, support, resistance levels. To me, that is an overriding thing for me generally. The thing is with trend lines, they line up well with things like Fibonacci's, which is to give the very most basic element of how to use Fibonacci's is that it's a concept that if a stock moves two steps forward, a typical correction is a one step back. And the
Yeah.
measurement of a Fibonacci is simply how far should a step back look like where the buying opportunities are going to prevail. And so if a stock is in a primary uptrend and going two steps forward, one step back, two steps forward, one step back, the trend line suddenly connects all the lows and it looks like this nice beautiful channel higher, which is another technical approach of just identifying that prevailing uptrend and when it changes. I feel that generally you want to always remember the one cliche saying, the trend is your friend. People are always shocked how long trends last.
Yep.
And the most challenging thing is being the rock star who thinks you're going to catch the turn point. And it's like, no, this is the top. No, this is the top. No, this is the top. Or at the same at the bottom. No, this is definitely the low. Or no, it can't go any lower. The easiest thing is I love this Stanley Druckenmiller saying where he basically says, I go all in the second inning of the game when I know the game has started, rather than trying to predict when the game has started at the beginning, right? Like
Yep.
you wait to be a little bit late, you miss the first part of the move, but you know that the next move that the trend has shifted and now there's a new opportunity here.
Mhm.
And so support, resistance lines, trend lines, these things are signals that can give you that. Indicators, the way I like to describe it, if I was to give an analogy, is okay. So imagine I'm a pilot of a single prop plane, and I've already put in 10,000 hours of flying time. For one of these small little propeller planes, most pilots that fly these things don't even look at the cockpit gauges at all. They just look out the window. They fly the plane, land it, and stuff like that. But when you're a brand new pilot, everything you're doing is staring at that dashboard, at every single gauge, tapping everything on your cockpit gauges, make sure everything is perfect and lined up. So what
Yep.
happens is at the beginning, you over rely like a crutch on all of these gauges and indicators. And as you become a seasoned trader, you become intuitive to the natural price action and you
Mhm.
crutch less and less on the indicators and you focus far more on how the price is developing and how it all interconnects and things like that. So I would find the answer, just to go back to answering that, is that the kind of trend line support resistances would be something that I personally would go to first before I would rely on oscillators, indicators, and other things like that.
Yeah, absolutely. I love that. And we'll talk about that in just a second. But I just want to ask you real quick, Patrick. I know we're coming close to our regular time here, but would you be keen to just hang on for an extra 10 minutes here as we're
Sure.
getting some questions showing up?
Yeah,
So
yeah,
we'll,
yeah.
we'll
Let's do it.
tackle those. All right, let's go for it. So, next question I'm going to queue up with you. This one's coming from Michael. Michael's is asking, how can I apply technical analysis techniques to interpret stock value trends? All right. I think we've talked about this. I'm happy to bring up a chart if you want to show a couple of things, but yeah.
Understanding fundamentals and balance sheets and corporations and business cycles, credit cycles, monetary policy, all these different elements. I don't think you need to go to that step of trying to use some sort of a technical overlay to analyze something that quantitatively can be analyzed. I
Yep.
feel simply that the technical analysis of the price charts simply is telling you when other people are voting with their money on what they believe. Like,
Yep.
if you've caught the turn on valuations and you think that this is the turnaround point on the stock, guarantee you're not the only one. There guarantee you
That's
there's
right.
a other value investors and other types of investors that are all going to be doing the exact same thing, and it can't be hid away from the way the price is behaving. And so it's sort of like kind of I wouldn't I don't know how to comment on that because I don't actively use it that way for myself.
Yeah, I know, because your approach has always been like that top-down approach where
Yeah.
fundamentals are really key to that rather than kind of that bottom-up where you're using signals to kind of find opportunities. So no, I
Yeah.
do appreciate that. And it's going back to that the what we talked about first. You like to trade technically fundamental good things there. So Michael, hopefully that speaks to that for you. Next question, this one's coming from Larry. Um, this is one. The question is, at what point do you widen your channel lines in either a bull or bear channel? All right, this is not one I'm too familiar with, but I don't know if you can speak to this one there, Patrick.
I don't think widening the channel lines is necessarily a sound thing to do. Because what you're sort of doing is saying, I'm trying to fit the stuff in with the way that I want to perceive the market. It's like I
Mhm.
want to widen it so I stay in longer or something of this manner. And I generally think that you don't need to respond to the trade the way of, let's say, selling it because your channel was broken. But I think that it's valuable information in terms of some sort of a deeper correction underway when a channel is broken. And so I don't think widening it to make it fit is I don't know how I would make more money as a trader by doing this. Like you can, even if there's a trend violation, unless there's a massive tax consequence to you disposing the position and making a sell decision, there's opportunities to always hedge, increase your positions, do add to your positions, take away from your positions. Uh, anyway, I don't know if I would be doing that. If you have the defined channel, I would just leave it as is to see how the price trades around it.
Okay, yeah, not tweaking a whole lot. So that's what I'm getting from that. All right, next question. This was from Bernie, saying, I watch a lot of technical analysis content online, and it seems that most traders tend to use a handful of indicators. We know some of the common ones, MACD, VWAP. Isn't there a risk of herd mentality that would make these indicators useless if everyone is using them? It almost goes back to the tenets of
No,
technical analysis.
I wouldn't actually say useless. Rather, what is happening is there's a reaction function that happens of people front running. So what ends up
Mm,
happening is if you use the exact same technique that everyone else does, and it has become evident to market participants that when this indicator does this, a large new cohort of buyers come in, then what inevitably happens is someone just tweaks the indicator to give them a signal earlier, and then front runs the signal only to sell into everyone else's buying. Ultimately, what this does is it will make the technique less effective. Therefore, people will use it less, and then it will stop being so overused. It's and
yep.
this is there is a self-fulfilling prophecy that way, but that actually I think is far more evident in day trading. When major macro trends prevail. So, for instance, in the bond markets, when the Fed um, started to raise interest rates, they raised interest rates now for almost 2 years. And every bond, especially 2 and 5 year duration bonds, had a prevailing trend that was a macro force that could not be it can't be just a bunch of order flow of traders. This is a macro repricing of the cost of credit that trickles into every other element. And if you're in the big picture looking at that chart,
Yep.
no trader that is using a signal of some crossover of some MACD is can manipulate or break the force of this big macro trend that is going to happen. And so the more you go micro and you're trading an hourly chart and you're looking at something that
Mm,
on a stock going, then of course those short-term imbalances, that's like where the gladiator sport happens. Was described. The more you go long term on your trading, the more you have blue ocean versus red ocean. While if you're in the short term sphere, you're literally the gladiator sport of every hedge fund, algo, high frequency trader,
mhm.
market makers, option flows. You can go into any array of that's going around. As a retail investor, you're like, I'm going to find an edge fighting against all of these people,
This-
right?
Yep.
And you might, but it's not easy. It's if you think there's an easy holy grail to day trading, I would say good luck. The it, I would say generally, um, the more you zoom out a little bit and the more you stay in prevailing major trends, the less the technical analysis could fail you, even if it's a very popular technique.
Yeah, no, I do like that. I for one definitely don't want to be caught up in that maelstrom. Not that I'm a gladiator by any means, but I'll step aside on that one and look at the bigger picture there. No pun
Yeah.
intended. All right, next question here. This one might be a final one for today, but this one's a question from Melissa, asking, "How do you decide what length of time a moving average should be when analyzing a stock?" All right, do you have your go-to
Yeah.
ones?
Okay, it all depends on whether you are actually buying or selling or whether you're using it for trend following. And
Okay.
so, for instance, if you want to think that if you want to get into a stock and you need the indicator or the moving averages to give you the buy signal, if you're waiting for a 50, 200-day crossover, you're going to be waiting for months. So if you actually want a signal that will give you a buy or sell, something like a 10 and a 20-day moving average would be a very clean technique to use for an entry. But if you want to just be on the right side of the trend, uh, just making sure that the stock you're trading is above its 50-day moving average has value. And so you just basically have to tweak it based on what you want to accomplish with the moving average on there. But one thing I will say, moving averages are lagging, and the shorter
Yep.
time frame you are, the more likely that the stock is going to revert to its average and give false signals above and below. So I like to generally use a little bit longer moving averages and not delve into the 8 and 14 period crossover kind of stuff.
All right. So I know you do like the 50, of course. That's the one you commonly use. But are you
For
using
trend
any of those
following,
long ones?
yes.
Trend following? Yeah. Okay.
Yeah.
Excellent. All right. I think we're going to leave it there, Patrick. I can't thank you enough for joining us and being part of our show today and sharing your wonderful insights. Before you go, any final thoughts you'd like to share with our viewers on the topic?
Listen, you know what? I feel that the one thing I just want to leave the listeners with is don't assume that technical analysis is a holy grail. All technical analysis, every one of these indicators is just a mathematical interpretation of price and time and the way the price is evolving. What it simply does, it allows you to see how everyone is voting with their money as opposed to just valuing a company. And therefore, there's room for it in every approach to trading and investing. It belongs in your wheelhouse. It should not be your sole way of investing, but it is a very good complement to actually creating structure for you in terms of how you get into trades, when you choose to get out of them, profit take, degross risk, when you choose to leverage up. All sorts of different things can be interpreted by simply seeing what the trends are. And the technical analysis is the only way you can actually really sense and see the way the price is behaving.
Yeah, nicely summed up there, Patrick. Appreciate it. Again, I can't thank you enough for sticking around for that extra time as well. So great kudos to you for that, and all to our audience as well who've stayed in and tuned in, and for your wonderful questions. Thank you again. Don't forget to look at our upcoming events and register for those. And if there's any other new topics you'd like to learn from, tell us about it. If there's anything you want Patrick to talk about, I'm sure we're going to have him back on here as part of our roster. Also, do check out our upcoming live webinars and on demand content that's available through our Learning Center and on Webroker, as well as our YouTube page. And with that, I will say adieu here. So, Patrick, thank you once again. I will give you back the rest of the afternoon. And thank you, folks, for tuning in here today. Until then, we will see you all next time.